Good afternoon. This is Xavier with Daley Paulk, and today we're going to be going over uranium. It's honestly my favorite asset class. We're just going to be looking at some charts, going over some ratios, and I'm going to be giving you guys a little bit of my opinion on the market. Uranium, it's definitely a part of the commodity energy sector. It's put into nuclear power plants for fuel generation, and it's also used as a substitute for natural gas and some of the other electricity generators like coal as well. The advantages to uranium are its energy return on its investment. So a pound of uranium uh, has like many multipliers of more energy than coal, oil, natural gas, wind, solar. I mean, you name it. And uranium's the most energy economically profitable. It has the highest energy returns on investment. Okay, it gives you the biggest bang for your buck per unit of capital. It's very efficient. It's very powerful and it's very efficient. The biggest caveat to uranium, I would say, is capital expenditures because uranium power plants are very, very expensive. They cost many billions of dollars. We are building technology. When I mean we, I mean honestly humanity as a whole. But we're building new technology, these small modular reactors to kind of like do some of those caveats. But the technology is still just technology, and it doesn't work all the time. But looking at the uranium price from 2008, pretty much till now, we've been in the technology bull market. Okay, that technology bull market coincides in it's truly because of the housing starts. Okay, during low housing starts, whenever housing starts are below the long-term occupancy average, which is pretty much where we're at right now, this little slash line, the lower it is, whenever it's going below it, that's the recovery phase of real estate. So if you look at the business cycle, we're just gonna be taking a look at a business cycle graph. This the depression and then this recovery move, the trout, and then the recovery. That is this 2008 to pretty much 2020 area right here. Okay, the trout, the recovery, and then after the recovery is the expansion. That expansion is the expansion in the housing market, and that's what creates inflation. So think about it like this: every time a new house is built, and then there's new loans getting put on the house, that's new money creation. And uranium as a commodity, it soaks up all of that money creation, all of the excess capital. It gets shown in higher electricity prices, higher commodity prices, wages go up, cost push inflation. So that technology bull market that we were, and I do say we're seeing, even though like we're in a consolidation period right now, because we are going to see a new increase in the housing market. But that manifested itself into a technology bull market from 2008 uh, till now. But it looks like around 2020 we broke out of like a simple movage averaging declining line. So we broke out of a declining trend line in 2020, absolutely ripped to the upside, and now we're making a pullback. Okay, let's look at some of the uranium companies. The first one is obviously Cameco Energies. All right, from 2020, this thing absolutely freaking moonshots. Okay, absolutely moonshots. But Cameco, it's probably one of the only profitable uranium companies on the market right now. Uh, Yes, they only produce $119 million of net income. Uh, they are still ramping up production. And like I said, they are one of the only uranium companies, really, one of the only big producers on the market right now. And you can obviously see that given how much the share price has gone up. The stock looks absolutely incredible. At least in aggregate terms, it's larger than it was in the last bull market. But don't get fooled by aggregate terms because whenever you throw this on logarithmic, you then obviously see that uh, the last one is still a little larger than where we are right now. Um, but there's still a lot of opportunity left. is what I'm getting at. So Cameco, that's a uranium company. Then Cameco relative to the commodity that it sells. So we're pricing Cameco to the underlying commodity that it sells. And yes, it's been going sideways, and only recently has it really been starting to go up. So this is very positive. Okay, in a in the equity bulls market, you need to see the companies outperform the underlying commodity that they're selling. That's how you know that these companies are uh, they have a good balance sheet, and not only that, they're displaying alpha relative to the commodity that they're selling. So investing in the companies should give you a greater rate of return than the commodity because the companies are just more risky. I mean, commodities don't default on their debt. There's no operating management risk with a commodity. There's no counterparty risk as well. I mean, but when you're dealing with companies, obviously in stocks, you're dealing with people, and with people, there obviously is immense opportunity. There's also immense probability of loss. You can lose. You can get burnt. The company can blow up. So during bull markets, you do want to see the companies outperform the commodity, and that's what we're seeing right now. Another good one is Denison Mines. Denison Mines breakout, it's doing the consolidation, and it's honestly starting to continue to rip up to this upside. Like Denison Mines is looking really, really good. Okay, there's probably my favorite. It's Deep Yellow. Deep Yellow. It's around what's its market cap? Like 1.5 billion, 1.1 billion. Since 2020, it's oh my god. Look at these returns, guys. This is why you got to be in really early. Since 2020, this thing's already had pretty much a 500, 600% increase in the returns, right? Let's look at Deep Yellow relative to the spot uranium price. Deep Yellow is a development company. They're not actually producing any uranium yet. This thing is going sideways. Big red candlestick over here, meaning that spot uranium actually outperformed the developer, which one could say is a bearish sign. Uh, but the developers do lag the producers. So money flows obviously are going to go into the producers because they're already showing production growth, and they're already selling the commodities, and they have long-term contracts. Uh, Money goes to them, and then it goes to the developers. But Deep Yellow to the underlying commodity, which has been just they're both going to the upside, so everything looks pretty good. Bannerman is also a really good one. Guys, look at Bannerman. So at the peak of the last bull market, it was around $35. The recovery phase of real estate drove this all the way down to the pennies. Okay, it became a penny stock, 36 cents, 40 cents, all the way down here to 2020. We break out to the upside. We've been consolidating. Okay, we broke out to the upside. We're just making a little rising wedge pattern where we're gonna keep on hitting this. We're gonna break out to the upside, and we're gonna moon. Okay, we're gonna moon, and this is looking really, really good. Energy Fuels is looking really, really good. Okay, Energy Fuels relative to, let's say, the commodity is looking really, really good, guys. These uranium companies are launching. You gotta be in this. You gotta be in this stuff right now. You gotta be in this stuff right now. Let's look at UUU relative to, let's say, the S&P 500. We know the S&P 500 is at all-time highs. It's breaking everything, right? Oh, well, it looks like what percentage increase is that? Oh my goodness. In 2025, it's been outperforming the S&P 500 by over 300%. So, uranium is looking really strong here, guys. There's a company called Lightbridge. I'm actually not in Lightbridge, but also breaking to the upside, going from $2.50 to $26 in less than a year. Guys, look at this. Look at this double bottom right here, guys. Uranium's looking really good. Okay, uranium's looking really cheap. So we looked at all the uranium stocks. We see them breaking to the upside. We look at uranium relative to gold. It's still at all-time low valuations, guys. At the end of the last bull market, it was a point 0.2 ratio, uh, meaning so during commodity bull markets, it does seem that uranium goes up at a greater rate of change than gold, and gold also goes up at a greater rate of change than the S&P 500. And we already seen that the ratio of the equities to the underlying uranium commodities are looking favorable for the equities uh, showing leverage to the commodities. So, guys, we're going to see uranium stocks just start to rip. Uranium stocks are going to start to rip everything, and there's nothing the market can do about it because it's like trying to drop a sea of liquidity into a bobby pin. It's just gonna go everywhere. Okay, the uranium market's just not ready for all of the money that is going to end up consuming it. And I know that because AI is a massive consumer of electricity, right? AI consumes a lot of electricity. Everyone knows that. No one wants to use oil anymore. No one wants to use coal. No one wants to use natural gas. If they really want to ramp up these data centers and the energy consumption from AI, they're going to use copious amounts of uranium. And they better get ready to sign some very expensive longer term contracts because these uranium companies are not going to sell them uh, uranium at only $80 a barrel. Why would they do that when they think uranium is going to be like $300 a pound? Uh, yeah, uranium's not measured in barrels, by the way, guys. But at $300 a pound, which a lot of these uranium producers are hedging themselves to get ready to sell for, like they're they're waiting out signing long-term contracts right now because they expect longer and more profitable term contracts to be able to be signed in the future. So, guys, put on your uranium pants. Do some research yourself. Look into the uranium market and leave a like, leave a comment, and let me know what you think. This is Xavier with Daley Paulk. Have a great day.